Hello, good day. This video focuses on put-call parity in options. We are going to learn about what is put-call parity and how useful is this concept. In particular, we can use the put-call parity to predict the value of call, put, and even the underlying asset price. In addition, we will learn how arbitrage activities can be conducted if there are disequilibrium between the option market and stock market. This topic involves substantial mathematical concepts. It may be slightly challenging for some students to imagine how the mechanism works. However, I believe the ability to understand complexity is an important training at university level. If you cannot figure out at first watch, I would encourage you to watch this video over and over again and draw up your own calculation and model. With hands-on practice, I'm sure you'll be able to master the knowledge. Let's learn together! Call and put values and the present value of the exercise price is called put-call parity. Put-call parity is a theorem that defines a price relationship between a call option, put option, and the underlying asset. Put-call parity is the relationship that must exist between the prices of European call and put options that both have the same underlying strike price and expiration date. Put-call parity does not apply to American options because they can be exercised prior to expiry. A fiduciary call portfolio comprising of a call plus bills portfolio can provide limited downside risk with unlimited upside potential. A protective put portfolio comprising of a stock position and a put position on the stock also provides limited downside risk with unlimited upside potential. If the two portfolios always provide equal values, then they must cost the same amount to establish. Therefore, the fiduciary call portfolio must cost the same as the protective put portfolio. The equation is called the put-call parity theorem because it represents the proper relationship between put and call prices. Another interpretation of put-call parity is that the put price plus the stock price always equals the call price plus the present value of the exercise price. This means that given any three of the following four variables, C, X, P, S, the fourth variable can be determined. The put-call parity can be proven using arbitrage. If the parity relation is violated, an arbitrage opportunity arises. To exploit the mispricing, investor can buy the relatively cheap portfolio and sell the relatively expensive portfolio. Next, we are going to learn how to build a model for put-call parity. This model is useful for us to estimate the equilibrium value of call, put, or even current stock price when the parity exists. In this example, the initial call price is $9, put price is $3, current stock price is $100, and the exercise price of the option is $95. The options will expire in 6 months period. The interest rate is 5% and the market volatility is 20%. Let's learn how to build a model for put-call parity. Let's learn how to build a model for put-call parity. I shall follow this equation. I'm going to type equal call price plus exercise price multiply with EXP. EXP stands for exponential, open bracket, negative interest rate times T, close bracket. and I obtain a value for the fiduciary call. Next, I'm going to calculate the right side of the equation, equal put value plus current stock price. Enter, and this is the value for the protective put. There are two portfolios here. The left side of the equation is lower. If we estimate that the call price will change, we can use goal-seek to calculate the equilibrium call price. This means the call price could be too low. Let's try and do it. I shall click Data, What If Analysis, Goal-seek. Then I set this cell here, alright, to value equivalent to 103, which is the right side of the equation, by changing the value of put. Click OK. Then the call value will change to 10.35, and both sides of the equation is similar now. What if the put price is $2? I'm going to change it to $2. As you can see, the left side of the equation is higher. If we estimate the put price to adjust, we can use goal-seek to calculate the equilibrium put price. Let's do it together. I'm going to click Data, What If Analysis, goal-seek. I'm going to set cell here, alright, to value 103, which is equivalent to the left side of the equation, by changing the value of put option. Click OK. Then you can see that the equilibrium value for put is supposed to be 3, and put call parity exists. This slide shows the summary of steps in arbitrage activity when the fiduciary call is undervalued relative to the protective put. At time 0, the arbitrager would buy the undervalued portfolio C, which means buy the call and invest the present value of exercise price in risk-free asset. The arbitrager would sell the overvalued portfolio P, which means sell the put and sell the stock. All the actions at time 0 are reversed at time t to close the position. The arbitrager would buy the stock at market price ST. The put will be exercised if the ST is lower than the exercise price. Since the arbitrager has a short position in put, there will be losses incurred. The call will be exercised if the ST is higher than the exercise price. Since the arbitrager has a long position in call, there will be a profit incurred. The arbitrager will receive proceeds from the investment in risk-free asset, which is the exercise price. This slide shows the summary of steps in arbitrage activity when the fiduciary call is overvalued relative to the protective put. At time 0, the arbitrager would buy the undervalued portfolio P, which means buy the put and buy the underlying stock. The arbitrager would sell the overvalued portfolio C, which means sell the call and borrow the present value of exercise price at risk-free rate. All the actions at time 0 are reversed at time t to close the position. The arbitrager would sell the stock at market price and receive ST. The put will be exercised if the ST is lower than the exercise price. Since the arbitrager has a long position in put, there will be profit involved. The call will be exercised if ST is higher than the exercise price. Since the arbitrager has a short position in call, there will be loss involved. The arbitrager would repay the loan at exercise price. Now we are going to look into an example on arbitrage opportunity. Suppose that the stock price is $31, the exercise price is 30, the risk-free rate is 10% per annum, the price of a 3-month European call option is $3, and the price of a 3-month European put option is $2.25. We are going to make use of the put-call parity equation to calculate the value of portfolio C and portfolio P. For portfolio C, we add the call price with the present value of the exercise price. For portfolio P, we add the put price with the current stock price. From the calculation, you can see that portfolio P is overpriced relative to portfolio C. Therefore, the correct arbitrage strategy is to buy the stock in portfolio C and short the stock in portfolio P. Buy portfolio C means buy the call and invest in the risk-free asset. Short portfolio P means sell the put and sell the stock. To buy the call, the investor pays the call price of $3. To sell the put, the investor receives $2.25. When investor sells the stock, he receives the current market price of $31. The net cash flow upfront is $30.25. This amount is invested in risk-free asset at 10% for 3 months. The future value of the investment after 3 months is $31.02. If the stock price at expiration of the option is greater than 30, the call will be exercised. If it is less than 30, the put will be exercised. In either case, the investor ends up buying one stock for $30. This stock can be used to close out the short position. The net profit is therefore $1.02. I would like to show you the Excel model for analyzing the arbitrage activity. Here, the put-call parity equation is used to determine which portfolio is undervalued or overvalued. You can see from the calculation, this is put price plus current stock price. This value is obtained from call price plus the present value of exercise price. From the result, we can see that the P plus stock portfolio is overvalued. The C plus present value portfolio is undervalued. The activity at time 0 is shown here. When we sell or short an instrument, the cash flow is positive. When we buy or long an instrument, the cash flow is negative. The net cash flow is the summation of these three values. This cash flow is invested in risk-free asset. The future value of the investment is 31.02. Here we have an assumption that the share price on expiration date is either $25 or $35. If the share price drops to $25 on expiration date, the put will be exercised. Since the investor has sold the put, the loss is $30 minus $25, which is $5 loss. The investor has to reverse the short position in stock and pay $25 for the stock. If the share price drops to $25, the call will not be exercised and the call will expire worthless. Therefore, the net cash flow incurred is negative 30, which is the summation of these three values. Investor will receive 31.02 from the investment in risk-free asset. Therefore, the net profit is 1.02, which is the difference between the cash inflow and outflow. If the share price rises to 35 on expiration date, the call will be exercised. The profit from the long call position is $35 minus 30, which is $5. The investor has to reverse the short position in stock and pay $35 for the stock. If the share price rises to $35, the put will not be exercised, and the put will expire worthless. The net cash flow incurred is negative 30. Investor will receive 31.02 from the investment in risk-free asset. Therefore, the net profit is 1.02. To sum up, irregardless of the market price at time t, the put and call contract will ensure that the investor will buy the stock at exercise price of 30. The net profit is fixed at 1.02. Finally, we have come to the end of this video. Thank you for watching this video. Please practice the examples given in the Excel spreadsheet as practice makes perfect. I hope to see you again. Bye.